Case 1. Investing versus speculating. Understand the difference. Investing is about thorough analysis, safety of principal, and a satisfactory return. Speculating, on the other hand, involves trying to profit from market fluctuations without considering the underlying value. Graham stresses the importance of recognizing this difference to avoid taking unnecessary risks. 2. Margin of safety. Buy with a cushion. The margin of safety is about purchasing investments at prices significantly below their intrinsic value. This cushion protects investors from errors in judgment or unexpected market movements, reducing the risk of loss. 3. Mr. Market. Don't let the market control you. Graham introduces the concept of Mr. Market, a metaphor for the stock market's erratic behavior. Rather than reacting to Mr. Market's moods, investors should take advantage of them, buying when prices are low and selling when they are high, based on the intrinsic value of the securities. 4. The defensive versus enterprising investor. Choose your strategy wisely. Graham describes two types of investors: the defensive, passive investor who prioritizes safety and a hands-off approach, and the enterprising, active investor who is willing to put in more effort for potentially higher returns. Each strategy has its own set of rules, and investors should choose based on their temperament, goals, and resources. 5. Diversification spread. Your risk. Diversification is key to minimizing risk. By spreading investments across different assets, industries, and geographies, investors can protect themselves from the impact of a single investment's poor performance. 6. Focus on intrinsic value. Invest based on fundamentals. Graham emphasizes the importance of evaluating a company's intrinsic value, which is derived from its financials, earnings, assets, and growth prospects. Investing should be based on the soundness of the business, not on market trends or speculation. 7. Be patient and disciplined. Stick to your principles. Successful investing requires patience, discipline, and a long-term perspective. Graham advises investors to resist the urge to follow the crowd, react to short-term market fluctuations, or let emotions drive their decisions. Instead, they should remain focused on their investment strategy and long-term goals.